Everybody was banking on another interest rate cut this year, but what if it never comes? In this month's Big Picture podcast with Australia's leading property tax strategist Ken Race, we're going to unpack why the economy is running hotter than expected and what that means for interest rates, for housing and for your mortgage. We're also going to explain why the Bank of Mum and Dad isn't just here to stay, it's now essential for nearly 1 in 5 first home buyers. They're getting financial help from their parents and what this means for housing affordability. And Ken and I are also going to forecast how Australia's rental crisis is about to get worse as investors are leaving the market in record numbers at a time when the government's got no way of achieving its big housing targets. So welcome to another episode of the Michael Yardney podcast, where I help give you clarity amongst all these mixed messages in the housing market so you can develop financial freedom through property investment. Lots to cover in today's show, so let's get on with it.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Ken, good to have you back. It seems that many homeowners and investors are all asking the same question at the moment. When will the next rate cut be? It's like we've become addicted to them, Ken.
It is. It's become the new sport, I think. You wonder what's happening to the betting markets as well.
Yes, well, I think you can actually bet on what
You can,
you can bet on
yes.
anything nowadays, can't you? But it seems like the economy is running a little bit hotter than expected. We know that we're recording this at the end of September, and most people will be listening to this just before the September Reserve Bank meeting. Some will be maybe listening, watching afterwards. But the Reserve Bank's cut rates 3 times this year. But with the GDP, the economy up 0.6% in the last quarter, consumer spending rising, are more rate cuts on the table?
Look, a personal position is I think there's more pressure to keep them stable than to bring them down at this point in time. We've seen the US now starting an interest rate reduction cycle, finally. While GDP growth, as you said, was quite strong at 0.6 in the June quarter, the yearly one is still lagging, I think, places certainly like the US, which is almost double. Inflation trim mean rate is at 2.7%, so just within the band.
Yeah.
So it's not going to take much to knock it over that 3% figure. So I think with the Reserve Bank thinking what's going to happen with the US, they've now seen, if you like, the impact of the US tariff increases. So while in the US inflation rate went up marginally because of those tariff increases, it was nowhere near the hysterical levels that everybody said. So I think they'll be keeping their powder dry. Our exports are certainly proving quite strong. While our prices of most commodities have come down for exports, the prices have come down, but the volumes have come up. So all that's, I think, saying there's going to be some further GDP growth, which could be making the Reserve Bank a little bit more cautious than otherwise.
Well, people would like the Reserve Bank to drop interest rates each time they meet, but looking back in the past, that wasn't the way it happened either. They dropped the rates, see how it went, and we in general believe that while some of consumer confidence has improved from the August rate cut, not all the follow-through effect has come through yet. So they're going to wait, I think, I agree with you, at least until the Cup Day November Reserve Bank meeting. That's actually in the past traditionally been when they did cut interest rates, Ken.
It is. I mean, it's a good holiday, so give people a holiday. And look, I think the Reserve Bank is a conservative institution, and I think a lot of Australians don't appreciate the harm, the injury that high inflation can do. And most of us, at our age, Michael, we certainly understand, previous times when interest rates went up and up and up because of inflation. And that actually creates a lot more pain in the economy than slightly higher interest rates period to period. So I think the government, the RBA in particular, is going to want to make sure inflation is well and truly under control.
Well, they look at a whole lot of factors, including employment figures and including household spending. And recently, household consumption has increased. And we've often said consumer confidence is the lifeblood of the economy. So it seems like consumers are feeling a bit more confident as well. And it's coming to the end of the year when there's the Black Friday sales and the Christmas sales. So I guess they're worried about that as well.
I think a lot of, can I say, vendors, shops, particularly in the retail industry, are keeping their prices down. And as you say, these Black Friday, the Amazon sales, et cetera, are sort of dragging a few more people into the market to buy things that, it's the old thing, do I want it or do I need it?
Yes,
And,
yes.
and and I think a lot of people have needed things, but have not been able to buy it because of uncertainty. So with unemployment at 4.2 odd percent, which is a pretty low number, not for the people unemployed, of course, or not for the underemployed people, but at 4.2%, people are feeling comfortable with their jobs. So a couple of interest rate reductions means that they can replace that refrigerator or couch or whatever.
So, in this macro podcast that we run each month, we talk about the big picture factors that are going to affect our economy, while in between, in my podcast, we discuss a bit about what's happening to property, finance, tax, etc. But one of the other big trends that's been affecting our housing markets, how more and more Australian parents are helping their kids buy a first home with less money. Now, interestingly, in the next week or two, the new federal government incentives, first home buyer incentives are kicking in as well, so that first home buyers are going to be able to buy a property with a 5% deposit, not have to pay lenders' mortgage insurance, and not be too worried about their HECS debt. So in Melbourne, it's up to $950,000, or Victoria, $950,000, Queensland, $1 million, Sydney up to $1.5 million, and higher figures in all the states, which means you're really able to get into virtually a median price property with the first homeowner grants. Of course, you've got to be able to pay the service, the debt, and you've got to have that deposit. But Ken, I just recently read that almost 1 in 5 first home buyers are now getting help from the bank of mum and dad.
It's the finance institution that keeps on giving, isn't it? We're
Yes,
seeing that anecdotally in Metropole Wealth Advisory because parents are coming to us saying, how do I protect this money, in
yes,
case my kids get divorced or split or, the 101 other
yes, yes.
scenarios. So we're helping a lot of clients put strategies in place that while the parents give the gift, it's done in a certain way that, can I say, is recoupable in the event of their children going through a family law court dispute. So we're seeing certainly more and more of that.
Well, according to a recent article in The Conversation that did a survey of a large group of parents and compared what they're doing now to 3 years ago, there are a number of strategies first home buyers were using to save a deposit. Many of them just lived at home longer with their parents. Others, interestingly, about 20%, spent less on eating out and drinking out. Others saved more slowly. Others took on a second job. But of all the things that first home buyers did to get into the market, all those they were actually doing less of this year than they did a couple of years ago. The one big thing that's changed in the questions was, I received money from my parents, and that went up considerably. Apparently, there's more and more mums and dads giving loans, gifts, or guarantees.
I think the hurdle for a lot of first home buyers was not necessarily the interest rates. It was more the time to save up that 20%
Yes,
deposit,
yes,
that time to actually have more money for the stamp duty. So while stamp duty isn't going to be as beneficially treated as the 5% scheme, having only put down 5% as opposed to 20 actually means that I'm putting a deposit down for a property at quarter the value of what it would have been historically for
yes,
me
yes.
able to afford. So 5% versus 20. So that's going to get more and more people in there, and increasing the benchmark at which it stops is now the government has realised that house prices are much higher than they actually thought they were, and therefore they're putting a more realistic market value on the dollar value of a property. Grandparents as well is a funny one that's coming through more and more. Grandparents are seeing that the money that they've put aside for retirement, the last couple of years, particularly on their super, has done well. So they're partly releasing some of that. And instead of waiting until they pass away and giving it to the grandchild, because on death, passing of some of that super money would have been very heavily taxed to the grandchild. Having it taken out and given as a gift basically has zero tax because the grandparents are in a zero tax environment in their super.
Now, interestingly, I saw some suggestions from Treasury that 70,000 first home buyers are likely to take up this new
Yep.
incentive in the first 12 months. And so if you put all those into the market, we've been around long enough, Ken, to see what this does.
That's
Well, we've
right.
seen it before. Give people more money, they will spend it. And that's really, apart from being a first home buyer grant, it's an established first home an established homeowner boost because a few are going to buy new properties and a few are going to buy new apartments, but the majority are going to be buying established properties from somebody who's moving up, moving out, right sizing, downsizing. So it's going to make the market keep moving, isn't it?
It certainly will. And there's a flow on effect because a first home buyer buying an existing property allows that person to buy their
Yeah.
second or third
Yeah.
property. And that puts more money in their pocket to then go and buy that upsize. And as we've seen certainly in a personal instance, a couple of my friends who thought they would downsize and have extra money, the downsizing options actually are costing more than the historical home.
Yes. Yes, in many cases.
Downsizing doesn't mean I'm going to have money in my pocket.
What all this does mean, though, is that the property market is going to remain strong over the next couple of years because even if interest rates don't fall in September, as we said, it probably will fall maybe November and then in February. That's what most of the banks and the money market is suggesting. Interest rates are going to fall. The economy is doing well. More buyers are coming in. We're not building enough homes. So the property market's going to be very strong. So some people may be listening to this, watching us and thinking, is it too late? And in my mind, no, we're at the beginning of the next phase of the cycle, which is going to play out with stronger price growth. Domain have come up with some forecasts and suggested Melbourne and Sydney will be the biggest recipients of the benefit of falling interest rates, but all our capital cities will be. And not all these first home buyers are going to come into the market on the 1st of October. Some are
That's right.
still needing to save a deposit. Others are renting at the moment and they've got 6, 9, 12 months in their lease. So it's going to happen over a period of time. But I see it as a window of opportunity. If you're watching this, listening to this and sitting on the sidelines thinking, should I or shouldn't I get in? Why not have a wealth discovery chat with one of the wealth strategists at Metropole? You're going to find that we're much more than just another buyer's agent. We help our clients safely grow, protect, and pass on your wealth through strategic property and wealth advice. And Ken and his team help with the wealth advice. I'll leave a link in the show notes or just go to metropole.com.au and get your ducks in a row. Look, we're 3/4 of the way through this year. And I know, Ken, there are people listening to this who made real good plans at the beginning of the year to do something. And then the economy kept changing. We had the wars overseas, the geopolitical problems, the scare about Trump tariffs. And they're all wondering, when is the right time? I don't know what your circumstances are, but why not have a chat with the team at Metropole? Because we've lived through these cycles before. So go to metropole.com.au. I'll leave a link in the show notes. But unfortunately, Ken, we're seeing that some investors, in fact, more investors, are actually getting out of the market. The Property Investment Professionals Association of Australia, PIPA, showed some analysis of the tax department figures because people put in their tax returns if they're property investors, showed the steepest annual decline in individual property investors in over 25 years. That excluded the global financial crisis and the little blip we had over COVID. The data that we've been also tracking for years shows investors are being pushed out of the market. We're hearing things about mounting higher costs, regulatory uncertainty.
Oh,
That's scaring people. And the fear of tax reform. That's really scared people, Ken.
absolutely. And we're seeing more and more people inquiring about their capital gains tax liabilities when they sell, meaning they're thinking of selling. And when you
Yes.
talk to them, the big thing is uncertainty. They
Yeah.
don't know what's going to happen in this capital gains tax regime. They don't understand what the government is going to do with the ability to deduct any shortfalls in their
Yeah.
rent versus expenses. We're seeing governments increasing the regulation on what a landlord has to do. I was seeing something the other day that tenants are now fighting for the right to understand the financial position of the landlord to make sure that the landlord can afford to keep that property
Wow.
so they're not forced to sell it and have that tenant thrown out. I mean, where's the world going?
Isn't that amazing? So the figures actually showed that there were 7,000 less individual property investors than the previous financial year. So this was looking at the latest tax statistics, 22-23. So the narrative from the media is all Australians are into property investment. There's more and more investors owning multiple properties, when in fact, this is looking at individuals as opposed to
Yeah.
companies, trusts, super funds. There are fewer of them. And of course, when they sell up these properties, Ken, the majority of them, well, at least 2/3, are being bought by homeowners. And that's going to happen more now with people having this ability, as we said a moment ago, with the first homeowner grants or the bank of mum and dad. So that's taking properties out of the rental pool,
Yeah.
meaning rents are only going to get tighter as vacancy rates fall more.
There's more pressure. One of the
Yeah.
most valuable pieces of advice I give clients when they're buying that first home is don't look at it as a forever home.
Yeah.
Buy it as an investment because, yes, you're going to live in it, but you're going to want to sell it to move into house number 2.
Yes.
So it's so critical to get that first property correct because that's what allows you to move up that property ladder over time.
Definitely. So it's normal to buy it with emotion. We're humans.
Yeah.
But in fact, it won't be your forever home. That's true. The other bit of news that came out since we had our last macro podcast chat was that nearly 80% of Australians don't believe we're going to hit the 1.2 million home target by 2029 that the government set. What surprises me about that statistic, Ken, is that 20% of people still do believe the
Believe it,
government.
yes. Look, I think that we're in a pincer movement. You know, they're being attacked from two sides. A supply of materials is being restricted and prices are going up. We're importing more and more building materials that should have absolutely been manufactured in Australia.
Hmm.
The other issue is regulation. And we're seeing it's on average, it could take certainly 8 months to get a DA on what you think is a vanilla construction. And I was heartened that the New South Wales government is looking at introducing legislation to reduce that to, I think, no more than 20 days.
Wow.
And they're basically telling the councils that you've got 10 days to tell somebody whether it's complying or non-complying.
Mm.
And if you don't advise the home builder, then within that time frame, it'll automatically be approved.
The problem is just because it's approved, Ken, doesn't mean it's going to come out of the ground. So
Correct.
houses in the outer suburbs, once they're approved, usually come out of the ground. But for developers to build the apartments that we're requiring, so you're right, the state governments are overriding the local councils and saying, you've got to build these properties. But the gap between what it costs to build and what people can pay has never been wider. Construction costs have jumped about 38%.
Yeah.
In just 3 years. Land costs and the government levies are high. Banks still, if a developer is wanting to build a new block of apartments, require somewhere between 70% or so of pre-sales before financing new apartments. But buyers are reluctant to commit off the plan, and developers are looking for a profit margin, otherwise they wouldn't
Mm,
build. So all that means is that it's not currently financially viable to build new apartments. We need them. We know that. So my understanding is there's only one way out of this. We actually have to have higher property values. Now, I know that's going to annoy somebody,
yeah.
but if established properties go up in value, then the new developments are suddenly going to start to look more attractive and people will buy them. So the problem isn't just supply. I mean, demand isn't slowing down. We've got huge immigration, household incomes are rising and rents are going up. So people do want to buy apartments, but we can't build them at a cost that's financially viable at the moment, Ken.
Certainly can't do it at a cost that's viable, as you say. And the time delays just
Yes.
add another layer of both complexity and costs.
Well, and
So
also risk.
uncertainty,
Risk.
risk.
And so therefore the developer is going to want a higher margin to cover that risk.
So buyers, predominantly through the bank requirement when they're lending, want fixed price contracts. So builders and developers have to build in what they think that cost will be over 2 years,
Yes.
3 years, 4 years if it's an apartment block. So that margin might look big at the beginning, but it has to take into account the risk of construction and the market risk. What will the market be at the end of construction? And will the market be able to absorb those properties?
Well, Ken, given all this uncertainties about interest rates, housing shortages, rising rents, investors exiting, what should a savvy property investor or somebody interested in getting in property investment be focusing on right now? What's your sage advice?
I think there's a couple of very key cornerstones. They've got to get the right finance. So, how much can I spend? Is it structured correctly? What name will I use, particularly if it's an investment? Even if it's an owner occupied, do you put it in one spouse's name, both spouses? You've got to buy the right property. That's probably one of the single most important things because that property is what's going to allow you to buy the next one. It's going to allow you to absorb, if you like, future price increases. It's going to allow you to have better tenants. That equity growth, if it's the right property, is going to allow you to borrow against that. So I think you've got to put those three things in the one mixing bowl and then come up with the right souffle, if I can put it that way.
Well, I know you enjoy your cooking, so I think you've got a good analogy there. Now, how do you help clients if they come to Metropole to get advice from you, Ken?
So specifically, we help people understand the structure that they should be buying in. If they're in business, how to direct their business income for the most advantageous tax outcome, how to protect those assets, particularly if someone's in a litigious occupation.
Yeah.
But more and more importantly is what do you do if the inevitable happens and you fall off the perch, you pass away? How do you pass these assets on in a safe way, tax effectively, to go to the right people? So we put together a holistic plan to help people, as we said at the beginning of this podcast, how to grow, protect, and pass on. So we work in tandem with your property strategists that they identify the right property and then we build everything around that.
Well, that's a big difference between Metropole and others. We're much, much more than others' buyer's agent. So if you want to take advantage of this new phase of the property cycle that is going to be underpinned by slowly falling interest rates, huge surge of first home buyers pushing up properties at a time when there's housing shortage, rising rents, and some investors who don't have the long-term perspective exiting, creating an opportunity for you, go to metropole.com.au. If you're keen to get Ken's advice, just click the tab when you leave your inquiry about wealth as well. And it's not just wealth money, but wealth strategy that's important. Ken, if we're going to have this conversation in 12 months' time, and we will, what do you think we're going to be talking about? What are we going to be saying about interest rates, housing affordability, and investor sentiment?
Can I be boring and say we'll probably be going over the exact same questions?
Yes.
There could be
Yes.
some slight, at the fringes. And, some of our assumptions will have been wrong. Some of them will have been right. But look, one thing I've learnt in, can I say, well over 40 years of property investing, the more it changes, the more it stays the same. Get good advice, buy the right property in the right structure. That's what sets you up.
And having seen this over many decades together, we know that most property investors won't get it right. We know that 50% of people who buy property sell up in the first 5 years, and those who stay in, 92% of investors never get past their first or second property. Recently, we did an audit of the results of our clients at Metropole, and they showed that they were 7.3 times more likely than the average investor to own 6 or more properties. I guess they got the right, they made the right decisions because they got the right advice. And if you'd like that advice, go to metropole.com.au. Ken, as always, you've helped us have a look at the bigger picture. And it's clear that many Australians are still waiting for some clarity from lower interest rates, from strong economic growth. Some are holding their breath while others are actually leaving the market. And that's put renters and the market under pressure. But as often said, times of uncertainty create opportunity for those who are prepared and those who are informed. So thanks again, Ken, for sharing your insights in between these monthly macroeconomic Big Picture podcasts. We have another podcast talking a bit about tax and structures and that, so we'll get back in a couple of weeks about that. But I look forward to having our Big Picture podcast once a month. And for you, if you've found this discussion valuable, please make sure you subscribe to this podcast. If you're watching it on YouTube or Spotify or listening to it on your favourite app, and you'll catch up with Ken and me. And do us a favour, why not share it with somebody who's also trying to make sense of what's going on in our economy? There's a share button on every podcast app, but it'd be doing Ken and me a favour, helping us get this message out to give some clarity in all these confusing times. Thanks, Ken. Look forward to catching up again soon.
Thank you, Michael.
As a way of having a bit of fun on these podcasts, each show I run a podcast trivia quiz and everyone gets a new report. I've actually just updated a report that you'll get a copy of if you leave your answer, and you could be one of the 3 winners of a hard copy, a real copy of Michael Yardney's Guide to Investing. Just go to propertytrivia.com.au. I'll leave a link in the show notes. Enter your answer to this simple question. What's the name of the tax deduction property investors in Australia can claim on the wear and tear of their properties? Go to propertytrivia.com.au. As I said, there'll be a link in the show notes. What's the name of the tax deduction property investors can claim on the wear and tear of their properties? Don't worry if you're listening to an older show, your entry will still count and you'll definitely get an updated copy of my report. I've updated what's ahead for property in 2026.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to ask you a question. What are you putting up with that's quietly holding you back? You see, most people believe progress is about addition. We chase new habits, new routines, new goals, new people. We think doing more will lead us to a better life. But the truth is often the opposite. The fastest way forward isn't always piling on. Sometimes it's letting go. So ask yourself, what are you currently tolerating that you shouldn't be? Maybe it's a draining relationship. Maybe it's a bad habit you convinced yourself it's just the way it is. Maybe it's an environment that feels safe but keeps you small. Or an old story that you keep telling yourself that no longer serves you. These things don't arrive suddenly. They creep in slowly. They're disguised as normal. And over time, what you tolerate today will quietly shape the quality of your years ahead. But here's the good news. You always have the option to stop, to notice, to question, to cut out what doesn't belong. Progress doesn't always mean adding more weight to your shoulders. Sometimes it means dropping the unnecessary baggage you've been carrying for far too long. So, my mentorship message to you today is pause and ask yourself again, what am I putting up with that I no longer need to? Identify it, address it, and remove it, because subtraction, not addition, is often the shortest path to growth. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?